Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. During the school holidays, I had the opportunity to read Reinhart and Rogoff's book, This Time is Different, 8 Centuries of Financial Folly. It's a quantitative analysis of all of the financial crises that have occurred over the last few hundred years. And it might surprise you to note, for example, that since World War II, there's in fact been 19, some of them major, many of them minor. What's interesting is the conclusion of the book. At the end of the book, the authors reveal that there are 4 repeating key ingredients that precede a financial crisis. The first one is rapidly rising asset prices, particularly property. The second is that we have burgeoning debt, whether it's government debt or private debt or both. The third ingredient is an expansion of the current account deficit. And the fourth ingredient is slowing economic growth. Now, as I was reading this, I couldn't help turn my mind to Australia. There is no doubt that Australia is in a property boom, and I would argue it has many of the elements of a bubble. We also have burgeoning debt. Private debt compared to GDP and household debt and mortgages compared to income are at record highs. So is credit card debt. With debt this high and so much money chasing property, there's little money to pay for anything else if asset prices fall and/or interest rates rise. The IMF has also warned that Australia has too much debt, and they're worried about our very, very high property prices. What about the current account deficit? Well, the current account deficit has averaged about 3% since the 1960s, but it's currently over 4.5%. So we also have an expanding current account deficit. And don't say that that's due to globalisation and capital flows. We are simply not earning enough from our exports to pay for our imports. It currently takes us or requires us to export something like 5 or 6 tonnes of iron ore to buy one iPhone. And finally, slowing economic growth. Well, Australia's currently growing at about 3%, but here's the problem. Perth is already in a recession thanks to the ripples that have emanated from the pebble dropping in China, that pebble being the end of the infrastructure or fixed asset investment boom that demanded so much of our iron ore, coal and steel. We think on the East Coast that we've got nothing to worry about, so we're blissfully unaware of the massive problems that Colin Barnett faces in WA. His debt, for example, has increased from about $3 billion to $27 billion just in the last few years. I think those ripples are going to move across the Nullarbor Plain and hit the East Coast. What will that look like? Well, we're currently building an oversupply of apartments. Now, residential construction is employing a lot of people in Australia, particularly on the East Coast. But when that oversupply hits, construction will slow and may even stop. And there may be a lot more people looking for a job. When that happens, we'll have the fourth ingredient that Reinhart and Rogoff talk about, slowing economic growth. Then we'll have all 4 ingredients for a crisis. How do you respond to this? Well, think about what we're doing here at Montgomery. In our long-only funds, the Montgomery Fund, the Montgomery Private Fund and the Montgomery Global Fund, we are slowly building cash. Remember, you want to be invested in high-quality businesses that are growing. We'd rather be in businesses than cash, but having some cash gives us an option over lower prices. And think about the timing of the release or the launch of the Montgomery Global Fund and the Montgomery Alpha Plus Fund. Both funds give investors the opportunity to profit from declining share prices. It's no coincidence that we've launched these products when we did. So raising cash in long-only funds is a sensible thing to do. So maybe you should talk to your advisor about raising some cash and having an option over lower asset prices as well. And speak to your advisor about investing in the Montgomery Global Fund or the Montgomery Alpha Plus Fund that can take advantage of lower prices if they eventuate. That's all for this week, and I look forward to seeing you again soon. Please follow us on Facebook and Twitter.